ran all your models, you did all your research, yet bad weather in New York completely crumbled your returns for this month. What I mean by this, there's an actual research telling you that markets depend on the weather. And yes, apparently, if you look at the stock returns compared to the weather patterns, apparently they have a very impactful nature to it. No pun intended, pun intended, I don't know. But you thought Wall Street traders look like this. In reality, they look like this. Jokes aside. What I want to talk about today is really just to focus on the specifics of how there's so many different ways by which the markets should work in the public, right? For the public stocks at least. But they don't, because people are just moody. They are affected by multiple different personal reasons. They're affected by personal traits, characteristics that make them irrational investors. And irrationality of the investment strategies across the globe is actually what's happening on a day-to-day basis. Like, we're in the vibe era, right? I've spoken in prior videos before how traditionally investments should work on the basis of fundamentals, right? You look at the company, you look how much money they make, you look at the outlook for them and the potential total addressable market that they're trying to capture, and you do some estimates. You're like, hey, if they keep the same profitability, acquire a couple of percentage more of the market because we think it's realistic based on the products they were launching, we can calculate the stock price right off of that because we can estimate their enterprise value maybe based on their, like, one of the ratios, and off we go, right? Or you can go and start looking at potential future product releases, look at the comparable markets and make some assumptions based on that. But it's always rooted in some sort of math. Where today, and especially in the past, I feel like few years, the market just went haywire. And it's primarily, I think, because when you used to have just a certain set of professionals, accessing the market, whether it's through Wall Street, whether it's through professional brokers, I think there was some semblance of at least some structure. I'm not saying they were rational, by the way. Like, they were also moody people. But there was this layer of, hey, we need to be predictive. We need to be really, like, data driven, like high frequency trading, right? We need to be able to create models that will allow us to work with our investment opportunities, work with our partners, work with our investors, and essentially pump the money and make the profits. Today, thanks to democratization of the applications, right? You have your Robinhood, you have your different applications that allow you to invest off of your phone. You have a much bigger set of folks entering the field. And I'm not saying that they're less sophisticated, but because they're a little bit less professional when it comes to the investments, a little bit more eager, especially in the current economic environment, to make an extra buck for themselves, because that's one of the only ways they think they can afford a lot of things in their life these days, like a house, right? Because your standard salary for a lot of people cannot even give them this. You have these layers now of additional personal behaviors that affect the rationality of the market. But now there are a lot more people, individuals who can together collectively move the market, right? And I wanted to kind of like prove this from the perspective of, like, if you look across the board on some of these logics, right? Like, there's one that I pulled over here, the net worth trap. And it's interesting research, like, it's worth checking out if you have a chance. But essentially the whole idea is that kind of like talking about the fact that based on where you are currently in your life, with the kind of assets you have access to, your decision making will obviously differ, right? Your criteria will differ. And because of this, how you react to certain piece of news, certain data analysis about certain company, your decision to invest a certain amount of money will differ. And it's an important factor because those individuals can be placed in certain organizations that shift the markets, right? And understanding the fact that although you might think and look at the company in a certain way and say, like, hey, based on this pure data analysis, this is how it should be evaluated, based where people are within this framework, they might make a very different decision. Or you obviously have your overconfidence bias, right? And you have individuals who really think that, my stuff doesn't smell. I know exactly what I'm doing. I'm making all the right calls, all the right decisions. And that also creates this environment where all of a sudden for them, they can make completely incorrect decisions. They can be part of those individuals who move the markets because they have access to a lot of capital. Or they can be influencers, right? They can be individuals who got lucky a couple of times, put up their scoreboard, so to speak, to tell you how much money they made. But in reality, they're just either got lucky, overconfident in both, and now they're trying to influence you and a lot of other maybe less sophisticated investors who have not done this level of analysis, and then everything crashes and burns when the wrong stock is picked. And that's where kind of like coming back to this whole like price to perfection idea. it's dead, I think, in my opinion. That's what it used to be. What I'm talking about, the fundamentals, you would make these calculations and you talk about the future expectations for the earnings of the company and you place your bet on it. But then right now you look at someone like Tesla who is not making money. Like Tesla makes less money than I think what they're paying like to all of their executives right now, right? Who are making all these big decisions. But in reality, they're selling some cars. Yes, they might launch a robotaxi or two. Maybe they'll sell a couple of robots. But this company is not worth, like, if you do fundamental research, I made the whole video on kind of like Elon Musk portfolio, but specifically Tesla, like it's a $200 to $300 billion company at its best if you really look at kind of like price to perfection approach. But it's like 1.6, 1.7, I don't know how many trillions right now. And it's all based on the vibes. It's all based on the overconfidence in the fact that, oh yeah, this company is going to go far without any track and proof of them actually being able to deliver on what they're talking about, right? And then you keep piling up from there. We've seen an era of the meme stocks, and that's what I was referring to, because when you start combining those influencers or very confident individuals who have an ability to articulate their ideas in a way that gets a lot of people who are less sophisticated in this decision kind of like all rallied up and like, let's go all buy GameStop, let's go all buy AMC, whatever else, right? Stocks were affected by this. You get these fluctuations in the market that you cannot predict based on the fundamentals. Again, it's very vibe based, and you, as someone who is maybe opening certain positions, will be completely caught off guard with this kind of fluctuations and the movements in the market. And I pulled up, and by the way, a lot of this, not a financial advice, of course, but also I pulled up some examples of these like penny stocks. But I'll tell you why the fraudulent slip there. Essentially, they're mining companies that I think in many cases don't even have any revenue. Their revenue is really just like, I think, like selling stocks, and they're really doing is trying to find the locations for the future mining and acquire rights to it and essentially sell them or sell the company, and that's how they make the money. And they have like crazy fluctuations. And there were like some creators allegedly caught promoting these stocks, and the movement was enough for them to make a ton of money for themselves and those companies. And it turned out that those companies were contracting those creators for those fluctuations, right? Specifically, so they essentially were engineering the environment. So again, you kind of like go through this process of so much information flowing at you from all the directions and so many different people trying to influence these stocks in ways that do not correlate with how the stocks should behave if you go by like a theory of its actual financial performance. The reason why I'm ranting about all of this is that it annoys me to a certain level that in today's world, you can be a company that did everything right. Right, you're a public company, you're playing it by the books, you have perfect filings, they're well audited, well, everything is documented. The company is just like humming and purring and moving along. And then you did not say the right number of times AI in your investor call in today's environment, and your stock craters by like 20%. Just because people are like, oh, they're not investing in AI. And it's like, guys, I don't know, car washing company or something. Like, there's no use for me here. But no, you didn't say the right keywords. Those people who, again, in many cases, and I have my whole, I need to make a whole video about all of my gripes about investment analysts, but they're also not always, actually, in most cases, in my opinion, not very well educated individuals on any of these topics. And they're trying to make decisions on what is a call, what is a hold, what is a buy. Like, don't listen to those people. You don't do the right things as a company. You kind of mess things up, you barely make any money, your filings are all over the place, you have a lot of extraordinary expenses on your books, but you did say you're investing in AI, and yes, we're looking at AI, and we're going to do a lot of AI. Your stock is up by 35%. That's it. You're the future. You're the pinnacle. Wait, it's okay. Amazon did not make money. They're not making any money. Believe in them. They're going to make money. Like, what are we doing here? Like, people use the survivorship bias of a lot of these companies that did work out, right, as an investment. And they forget about hundreds upon hundreds upon hundreds of companies that went bankrupt, that did not make money, that were not organized, that were trying to jump on whatever that latest trend was at that time and added .com next to their name back in the early 2000s, went into financial services somewhere in the mid like 2010s, went into, again, what do we have? We had blockchain, we had AI now, like right in 2020s. But then, like, they're not good companies. They're terrible investments, but because they said the right things, because they influence the right people, and those people influence the decisions of those investors who are not super sophisticated in all these topics, they were able to overcome certain situations in some cases and become these terrible examples of companies that we should not be following. We should be rewarding people who are doing the right thing, being quality companies with quality revenue, quality profitability, quality organizations, right? Safe investments. And we punish them because they don't use the right keywords during the conference calls for the earnings calls. And then we wonder, like, why aren't there good companies to invest in anymore? Yeah, because you incentivizing completely terrible behavior and you're not monitoring for this behavior. Like SEC is a joke right now, right? Especially on the current administration, they don't barely audit, I think, anyone. And if they audit, it's just like even that probably is too harsh. They don't care, right? They all kind of like, as the joke was in what's Big Short, that half of them are like floating their resumes to all these banks to work for them anyway. And so they don't monitor for the situation. So again, we are promoting bad behaviors. We're rewarding people who are not really doing the quality work. And then we wager our money on this. Like at this point, when I look at the stock market, and especially it's funny with the prediction gambling, all these gambling companies coming in, I don't see no difference. For me today, if you look at the stock market, picking a stock is identical to just picking a horse or picking a team for some gamble for some parlay that you're trying to set up. That's about it. Like honestly, the stock portfolios these days remind me more of parlays than they remind me of anything else. Granted, parlay is a binary 1 to 0, and the stock, some part of your portfolio can go down, can go up, but like you get my point. It's very rational. It's impossible nearly to predict, and you have to wager your money and hope things will work out. And there's certain trends, again, I hear you. Like there's certain trends we've seen, right? Like there are whole conversations about when the gold goes up, usually like the silver goes up. And so people, when they see the gold coming up, they invest in silver trying to catch the wave, right? There's certain events that can influence other events. Like if you, I don't know, you see the oil going up in price, you can probably go look at the correlations and understand like, hey, certain companies like trucking companies are probably going to be squeezed on their margins. So that's companies to divest out of. Or maybe you have a bunch of refineries that are sitting idle right now for certain Brent crude oil types. Hey, maybe you should go invest in them because you anticipate they're going to have an increase in demand, right? Like there are ways you can predict certain things, but again, it becomes more of a one of kind of like directional guesses, right? And as you can see, a lot of them are related to the commodities, something a little bit more hard fixed, but general broader stock market today is just a gamble. It's a constant gamble. It's hoping that your bet will work out. And with all of this, my point to you is don't overcrank on the things that you hear, right? Like don't get influenced by a bunch of different, whether it's articles, whether it's analysts, influencers, right? Be thoughtful about what you're trying to achieve, right? Like what is your investment goal? Are you trying to save for a house? Are you trying to pay down debts? Like whatever they might be. And pick a more conservative strategy. Like that's my genuine opinion right now. And again, it's not financial advice, so you can pick what you want. But if I would be me right now, I'm going very conservative. I'm not relying on the markets unless, again, as I said, I treat it as a gamble. Like if you go to the casino, you place everything on black and you can afford losing it. You can probably go invest in the same amount in some of these markets and hope it will go one way or another, right? The main point here is that you want to be thoughtful about what your actual goal is. Pay attention less to all of these things, all this noise that is happening, because you will never catch the market. Anyone who's trying to sell you a course, everyone who's, all these influencers who are trying to come up with like, hey, here's a strategy on how you're going to make money. If that strategy would work, they would have a hedge fund and they would be investing. It doesn't. That's why they sell the course. That's how they make their money. So pick the conservative scenarios and investments appropriate for your current scenario. Don't overextend yourself. And in reality, understand that a lot of these old methods, a lot of old fundamental based investments, your candlesticks and all that stuff, some people still draw triangles. I don't know why. It's impossible to predict anything anyway. Just focus on the conservative things that are more reliable. If there's maybe a real estate investment opportunity, maybe there is a treasury bond opportunity, things of that nature, that again, fits your actual stated goal. Because if you try to go out there in the public market right now and you try to make an investment, just treat it as a gamble, treat it as a casino, and approach it with the same logic. Wager just what you can afford to lose. And that's it. We'll see if markets ever stabilize, and maybe with more and more people and better education, more sophistication, things will improve, because statistically, in aggregate, it should start driving itself towards more of a correct, state of things, because in aggregate, people should be making statistically better decisions. But also, again, because of the nature of things and how it's treated as a gambling site pretty much right now, I don't have too much hope into it at this current moment. I'll see you next Saturday. Peace.